Who wins in a fight? Technical or fundamental strategy? There have always been two groups of traders or investors: technical analysts and fundamental analysts. They usually don't go together well because everybody thinks the opposite and they hardly ever agree on anything. So, which of these approaches is better for us, for traders? Some of you know that I studied finance at the university and that I also worked as a market analyst for a brokerage company. Afterward, I started trading full-time. At school and in the brokerage company, we were mostly taught and led to fundamental analysis, which was prioritized there. Currently, as a full-time trader, I focus mostly on technical analysis. So I learned my share of both. For this reason, I think that my opinion on this topic could be at least interesting for you. Of course, you are free to disagree. I will gladly have a discussion with you in a discussion panel below the article. First, I must say that in both groups, technical and in fundamental analysts, there are some kinds of people who get on my nerves and with who I strongly disagree. Among the technical analysts, it is those guys who use all those indicators the internet is full of and who act like they found the Holy Grail among them. In the other group, the fundamental analysts, I can't really take seriously all those big company analysts who tell you all the reasons why something happened. Yes, like something happened in the past. For example, the Standard & Poor's index went down yesterday. Well, here are 5 reasons why. Well, how does that help me today though? I don't really care why it crashed yesterday. I need to know how to make money today or in the future. Let's now have a closer look at technical analysis and fundamental analysis. Let me tell you what I consider the pros and cons of working with those different approaches. I will also show you how to best apply them to predict the market movements. So let's start with technical analysis and let's have a look at its ability to forecast. If you have a good trading strategy, then the technical analysis is definitely able to forecast future price development. It can successfully be done on all the time frames. It is also able to tell us where the price will turn or whether there is a chance the current trend will continue or not. Take for example the volume profile strategy that I teach. It is able to predict with high probability the places where the price will turn. You can apply this strategy to any time frame and to any trading instrument. I can't really say the same about the fundamental analysis though. Sure, there are cases where even the technical analysis fails. It is mostly when the markets are news-driven, when there is a strong fundamental factor, like for example unexpected change of central bank's rate policy. Then the technical analysis often fails and the price just shoots past all the strong zones. That's simply because the markets went crazy about the new unexpected situation. If there isn't a fundamental factor like this, the price reacts quite reliably on volumes and on price action support and resistance zones. Let's now have a look at fundamental analysis and on its ability to forecast on short and mid-term time frames. There is an economic theory called the efficient market hypothesis. It basically says that every significant piece of news is almost immediately reflected to the price, and therefore it's almost impossible to constantly profit from it. Being a trader for so long, I tend to agree with this theory. You know it yourself, when there is strong news, the price jumps up or down, or both up and down, again and again, and then the markets are just calm again. That's a common phenomenon. Well, how do you want to profit from that? This is exactly why I think that in a short and in a mid-term time frame, you can't really make any constant profit using fundamental strategy. If it was possible to forecast macro news numbers and the reactions to those numbers, then it would also be possible to predict price movements in short or in mid-term. However, In my endeavor to do this, I came to a conclusion that it is close to impossible to guess the outcome of the news and to predict how the markets will react to the news. You may be right a few times, but in the long run, it just doesn't work. So my conclusion is that in the short and in mid-term time frames, it is not possible to make constant profits using fundamental analysis. Now I would like to tell you something about the efficient market hypothesis in the real trading. A few months ago, I released an euro-dollar analysis where I predicted that the price of euro-dollar would drop severely down. There were people who told me that this was crazy because all the fundamentals pointed to strengthening the euro-dollar. There is one important thing though. All the fundamentals were already priced in. This is the efficient market hypothesis in the real trading. It is the surprise that drives the price, not the things that everybody knows. So if there aren't any new unexpected news or any new unexpected fundamental factors, then it is best to follow solely the technical analysis, like I did it with the euro-dollar in my analysis. Another thing in which the fundamental analysis fails is to tell us where the price will actually turn. Technical analysis is able to do it, for example, the volume-based technical analysis which I use. Fundamental analysis can only indicate that some asset is underpriced or overpriced, but it fails to tell us where the price will turn. It only tells us that the price should turn, but it doesn't really tell us where. Now let me tell you something about the fundamental analysis and its ability to forecast on long time frames. Fundamental analysis works quite nicely in the long time frames actually. Traders and investors use it most often to find assets like stocks, indexes or commodities that are underpriced. This means that an investor is trying to buy an asset with a bigger value than the current market price of the asset is. So if you find a solid company with strong fundamentals and which isn't overpriced, then you will make money as the company will grow and more people will understand its true value. This can be done not only with stocks, indexes or different futures contracts. Such fundamental analysis also works with currencies. Since most of you guys here are currency traders, I think that you may be interested in how to approach evaluating currencies from the fundamental point of view. With currencies, you need to consider the whole macroeconomic situation of the country or the region emitting the currency. The reason is that the currency is only as strong as the economy behind it. The most important factors in evaluating this are, for example, health of the economy or resources, or how strong the government and the laws are, or if it has its own currency and if the country has an independent monetary policy which they can apply. So, for example, I think that good and healthy currencies to invest in are, for example, the Australian dollar or the Canadian dollar. Both Australia and Canada have a healthy economy. Their debt isn't astronomical, unlike, for example, the United States debt. They have natural resources, they have independent and solid governments, solid law system, and they have their own independent monetary policy which they freely apply. So let's say that you want to invest in the Australian dollar. So you use the volume profile tool to look for a good place to enter your long position. You can use the same volume setups that I teach in my course or in my new book. In this case, if you look at the Australian dollar, US dollar, now you will probably need to look at the chart. There is a rejection setup on the monthly Australian dollar US dollar chart, and strong rejection like this indicates that there were strong and aggressive buyers rejecting the lower prices. It's likely that they placed most of their positions around 0.66, That's where profile is the thickest within the rejection. And when the price makes it back to this price level again, then I think that those aggressive buyers will defend their long positions and that they will push the price upwards again. And yes, I know that this level is 10 years old, and I think that the market still remembers it. The markets have a really good memory, so even though it's 10 years old, I'm pretty positive that markets remember this level. So, to sum it up, if we would like to invest in the Australian dollar currency, then a good place to do it would be around 0.66. Of course, this is not a trade recommendation, this is just my idea on the Australian dollar. So my conclusion from all this is that if you want to trade on lower time frames, then don't bother with the fundamentals. There's no way you can predict their outcome and use them to your advantage. You will do best to focus solely on the technical analysis. If you feel more like an investor and not a day trader or a swing trader, then I think it's best to combine technical analysis with fundamental analysis, like I did with the Australian dollar. This way, you can, for example, find solid stocks, indexes, or currencies using the fundamental analysis, and then you can find places in the chart where you will purchase these assets, and you will find those places with technical analysis. The best way to search for such places is, in my opinion, the volume profile, which I consider the most superior tool the technical analysis has. Alright guys, so that's it for the article. I hope you like it, and until next time, happy trading!